Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
You got to make sense of it all.
Exactly. We can do that with Cam Dawson, Chief Investment Officer at NewEdge Wealth. She joins us here in our Bloomberg Interactive Broker Studio. Cam, what did you make of the trading activity yesterday? It was really a whipsaw.
Yeah, yesterday was an outside reversal, or what we call in show business a bearish engulfing.
Oh boy.
So when you have price action like this, it usually does precede more volatility, which just means that we should get used to seeing some more of this chop. We're looking for the 6,500 level where we're trading right now to hold. That's really important. That's your 100-day moving average. If that doesn't hold, it brings 6,100 in play, your 200-day moving average, which would also be the peak back in February. So if you got to those levels, you'd certainly see more oversold conditions. Notably today, the market is not oversold yet externally on something like an RSI. It's also not oversold internally, meaning breadth hasn't been totally washed out yet. So all of this put together, probably expect more chop and churn.
So yeah, because the S&P 500 finished yesterday just below its 100-day moving average. We haven't seen that happen in months. I think the last time was when President Trump announced the tariffs back in April, right?
Yeah, and I think it's fascinating that just a couple of weeks ago, we had the longest streak above the 50-day moving average since 2007.
Wow.
So we were in this environment of incredibly low volatility, which of course we know low volatility tends to breed complacency. And we saw complacency in many places with FINRA margin loan balances surging higher by 35%, which meant retail traders were going all in, adding leverage. All of this suggested is that people were thinking that the good times were going to keep on rolling. But of course, as we know, the law of perversity is that the market will work to make the greatest fool out of the greatest number of people to the greatest possible extent.
Yesterday was a day, we had the NVIDIA numbers Wednesday evening, setting up for good trading on Thursday because it seemed like the AI play was still very much in play. But then it wasn't. Yeah. So how important is that AI theme as a growth driver for the overall market? How important is that still?
It's still incredibly important. And we think that there's an important nuance to the NVIDIA numbers, which is that NVIDIA's strong earnings actually makes the questions around AI overspending even louder.
Okay.
Because the AI questions were not whether or not companies were spending. We knew that. We knew that by the CapEx guidance. So we knew NVIDIA results would be good. The big question was, are the people who are spending on AI CapEx, are they earning a return on it that is justified to different shareholders, not just their equity shareholders, but now all of this debt that they're raising as well?
So then what's it going to take for the market to feel better, I guess, about all the CapEx spending in AI?
Yeah, it's an interesting question. If you were to see somebody like Meta come out and say, we're reducing our CapEx spend next year, potentially because the stock is down so much, how would the market react? Would they be supportive of that? Or would it cause a further unwind of all of these earnings expectations, as well as valuations that are built on this idea that you're going to see trillions of dollars of spend? So I think that is the big question as we go into 2026, is that do they continue to ratchet up CapEx expectations in the face of a market that seems to have lost its tolerance for it?
So we did get a lot of economic data today. We're going to get some more today with some PMIs. We're going to get the UMich data as well here. How do you think the Fed is kind of ingesting all this data we're starting to get now?
Yeah, well, the data is now so backward looking, and important to note that when they meet next in December, they're not going to have the October or November jobs report. So they're still going to be in this flying blind, which means that it's likely that they lean towards this hawkish side of things in the unknowing of what the jobs market is doing. I would say, though, is that if we see this equity market volatility continue, it actually likely pushes them more towards a rate cut. Because the best argument that you have for not cutting rates was looking at broad financial conditions. But if broad financial conditions, which include equities, include credit, and include volatility, if those move to tighten, that actually could push the Fed to delivering a cut because of what it could be implying about the underlying economy.
So I'm just curious how much of this, aggressive selling that we've been seeing is really about technical dynamics?
I think it's a large part of it, because when we look at the trading in September and October, it really wasn't justified for as high as things had moved. You had over a 30% rally in the SOX in those 2 months alone, the semiconductor index. So there was a frothiness, a speculative nature of the way that we saw things trade back in those 2 months. So we've effectively now reversed most of that rally higher. And the question is, do you have to shake out any further hands? Because you saw so much leverage being added and you saw people really trying to add on to risk, some of that is just getting the air taken out of it.
Earnings. We had a good, solid earnings this season. We still have some more retailers to go here, but double-digit growth in the third quarter, double-digit growth in the second quarter. How do you feel about the earnings power of this market? Is it enough to support this market?
Yeah, we continue to come back to looking at forward earnings expectations and say, look, 25 and 2026 estimates are still moving higher. That is usually broadly supportive of risk assets. The caveat to that is that earnings do lag overall prices, meaning that the street consensus will always be late to the game. We've been using the song, the deep track from Britney Spears' first album, Don't Let Me Be the Last to Know. Because earnings usually are the last to know when you see a turn. Go back to a year like 2022, you had a peak in the market that was actually 4 to 5 months before the peak in earnings estimates. So what we continuously have to do is really test earnings estimates to think, are they continuing to be revised higher, or potentially are there rooms for revisions lower?
Read those tea leaves. This is what we try to do.
All to a soundtrack of Britney Spears, yes.
All right, Cameron, thank you so much for joining us. Really appreciate it. Cameron Dawson, Chief Investment Officer at NewEdge Wealth, trying to get a handle on this market. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We know we got that much delayed September jobs report yesterday. It was a mixed bag at best. And it was just part of the story that we saw, that volatility yesterday in the stock market. So let's talk econ data, which now we're getting more and more of it now that the government shutdown is over. We've got Yelena Shulyatyeva, senior economist at the Conference Board, with us here live in studio. Yelena, what did you make of the reaction to the jobs report yesterday, given the fact that it was 2 months old?
It's 2 months old, but that's what we have. It was so exciting to finally have the data, right? Well, it's kind of the last clear data ahead of the shutdown, right? So, and already you see a pickup in the unemployment rate. Even before the shutdown, is probably going to affect the data on the private jobs. Right. We will probably also see a pickup in the unemployment rate, given that a lot of federal government employees are rolling off from the payroll in October. So that's a signal that the risks to the labor side of the dual mandate for the Fed are actually rising. So to me, the market reaction yesterday makes a lot of sense with the odds of a cut rising, right? But I think it's still very undecided territory. You know, there's a lot of discussion about, payrolls itself. The headline reading was pretty solid. So whatever you want to make of it.
I have a follow-up on this unemployment rate, though, going up second month in a row, right? Well, we're talking about September now to 4.4%, highest in 4 years. Well, what do you make of some people going, but wait a minute, it rose for the right, quote unquote, right reasons? Because workers who were on the sidelines came back in and were actively looking for work. And I guess that's when you're considered unemployed, right? Is when you're actively looking for work. You're part of that survey. What do you make of that?
I agree that, unemployment rate rising because people cannot find jobs and they're looking is better than outright layoffs. But, permanent layoffs also increased in the report yesterday. So again, there's a lot of mixed signals there. And yes, the unemployment rate increase since it troughed back in 2023 has been driven by long-term unemployment, people not able to find jobs. At the end of the day, whatever the reason is, the increase in the unemployment rate is a bad thing. And if anything, it increases the risks that things could deteriorate. So I think it's still unclear what's going to happen on December 10th.
Yelena, is there an unemployment rate? Is there a headline rate that the Fed says, oh boy, we got to do something here in terms of maybe getting a little bit more aggressive? Is there a rate out there they think is a trigger rate?
Well, they do have a summer of economic projections, right? So I'd say that should be our goal in terms of seeing what they think is bad and good. And if unemployment rate continues to rise, and probably in October and November it will rise for the reasons that I mentioned, that would go above their projection of what they see as a predicament for 3 rate cuts this year. So that should be our guide, I think. But in terms of like an absolute value, there is no such thing. It depends on the supply side.
Right. Now, as we start to get more economic data, we're going to start to get reports where the government shutdown, you can really see it play out in the numbers. My question is, how much should we hang our hat on those numbers because the government shutdown was just a moment in time and now it's over?
Well, you have federal government employees leaving for all kinds of different reasons. Are they going to be able to find a job that easily in the private sector when the hiring rate is so low? So yes, okay, I understand the shutdown is over. I don't think that the rebound will be,
okay, you don't think it'll be really quick. You don't think it's going to be a full one. So you think we're going to take a big hit to GDP because this was the 43-day shutdown?
We estimate half a percentage point in Q4. So it's lower than, say, CBO's estimate. We still have some time in the fourth quarter to recuperate some losses. So probably half a percentage point, which is significant by historical standards.
So it appears in this labor market, there's some layoffs, but there's not like a mass layoffs, but there's certainly not big hiring out there. Is that a typical environment for a labor market where they're not letting people go, but they're not hiring them?
It's quite typical for when the economy is kind of at a full employment. So it's a good spot to be. It doesn't mean that things are deteriorating, but it's a risky situation because, what's the next step for a company if you need to cut costs? If something, happens, some exogenous shock happens, you don't have that cushion when you can kind of like slow down your hiring to cut costs. The next step is layoffs if something happens. But so far, it's been relatively healthy.
Were there any signs in this jobs report that raised inflation flags for you? I know wages went up, not by a lot. And, is it keeping up with inflation? I don't think so.
It's still elevated. It's still elevated, but it takes time. And I always look at Atlanta Fed numbers, job switches, job stayers. There's no big margin between those two right now. So to me, it says that labor market wage inflation is subsiding. So it should not be a big source of inflation going forward, which actually Chair Powell mentioned a few times.
It's one of the greatest functions, I think, on the Bloomberg terminal. And there's a gazillion functions. Fed Go, FED Go. It just gives you everything you need to know about the Fed and the data points and the next meetings and the news and all that kind of stuff. So whoever did the Fed Go, pat on the back there. December 10th, it tells me, is the next meeting. What do you think the Fed will do?
They'll wait till the last minute. The beige book even matters, like the one that we're getting ahead of the Thanksgiving holiday. So how bad or how good it is? Is it the state of the labor market? Where is it? And what are companies saying about inflation and passing the costs on to the consumer?
Yelena, where is it written in stone that the Fed has to have a meeting on a particular day? I mean, if the government's saying, look, we're going to put out the November jobs report, which is going to have a little bit of the October jobs report December 16th, why isn't the Fed just going, okay, well, we'll move our meeting to like December 17th?
Well, that's going to be a havoc in the markets, okay? So that's probably not a good idea to do. There are a lot of different things. The Fed is data dependent, but they don't have to be like literally data dependent. There's still a lot of alternative data. And, you guys have this Alt-Go thing on the terminal. Yes. So there's still a lot of good data out there to for us to understand what's going on. I think the thing is that the risks to the labor market are still elevated, is still true. And that's why the Fed cut 2 times in the fall. So,
right. All right. So we've beaten this labor thing to death. Just give us your quick call on the inflation environment out there.
So hard to tell without the data. We do have good data on the labor market.
Just like the Fed.
It's very difficult to kind of try to gauge what's happening on the inflation side. Stephen Myron, the governor, was on Bloomberg TV just a few minutes ago. Yes, and he was saying that, this housing inflation is probably a reflection of what happened in the past. So we cannot really look at 3% inflation and say, okay, this is the true state of affairs. Housing inflation is subsiding. The data is not reflecting that. The labor market inflation is probably also subsiding. So service sector inflation is moving in the right direction. We probably have a little bit of a tariff inflation in the goods prices, but that will too subside. It will just take some time. It will be a temporary increase in inflation, but I think in a big scheme of things, inflation is probably going to subside next year.
All right, Yelena, thank you so much for joining us.
My pleasure.
Yelena Shulyatyeva, senior U.S. economist at the Conference Board, one of our favorite former economists at Bloomberg. We appreciate getting some of her time. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's go to a professional here when we think about these markets. Jeff Krumpelman, he's CIO and head of equities at Mariner Wealth Advisors, located in Cincinnati, Ohio, one of my favorite towns. I used to go there all the time to see a couple of institutional investor accounts. Would try to go see a ball game when I was there.
Absolutely.
It's a great
Good
town.
for you.
Jeff, thanks for joining us here. What's your call here? You look back on 2025, equities have done well. Yes, it's been volatile. Fixed income is done well. We got some solid high single digit returns there. What are you thinking about as you think about 2026?
So our thesis going into this year was clear air turbulence, which I think pretty well describes what's going on. I think that's still apropos as we go into the end of the year. And, as people try and prophesize, and they're trying to find reasons for what happened yesterday with some mixed news, the thing about clear air turbulence is there's no radar systems to detect it. Yep. It just happens in clear skies. So in terms of what we do think will play out, we had a target of 6,600 on the S&P for calendar year 2025. I think we're going to be, pretty close, and that's a pretty nice outcome, albeit with a bit of air pocket in there. Our kind of theme and thesis as we think about 2026 is the year of risk awareness and diversification 2.0. So I think you want to avoid concentrations. I think you do want to be a little more balanced than we've seen this year, and I think that we're going to have healthy results. But the market's kind of tired as we go into the year. We would be just fine as people talk about bubbles and troubles, which we don't agree with. But to see the market kind of rest and digest the strong earnings for a quarter or so, I think would be very realistic.
And probably a healthy thing.
I think, yes.
Yeah.
So
let's talk valuation because, right, a lot of what the volatility we've been seeing has been centered around are these stretched valuations we're seeing particularly in AI. But you say valuation is a poor timing tool for investors.
Sure.
What do you mean by that? And then what would be a good timing tool?
Well, people, it's funny. They're all wiggy about valuation now. We've been at 22 times earnings for a long time.
Right.
We were 22 times going into this year. We're a little less than that right now. So the advance has been earnings growth, not valuation. I think the AI trade has made people more, this is like 2000 and just more sensitive to valuation now. It's always been there. And it's a terrible timing tool. So whether you talk about Alan Greenspan irrational exuberance in 96 before it doubled in 01, or you talk about questions I've been getting going all the way back to 2017, 18, when people said, hey, Jeff, 22 times is rich. How can we go up from here? And you have double-digit targets on the S&P 500.
Right.
So it's just a very terrible. It's fundamentals and valuation can remain elevated if fundamentals are strong. And I'll add this. This is not your grandfather's index. When people compare this to the 50-year average of 15, 16 times earnings, back 40 years ago, industrials, financials, and energy were 50% of the S&P 500 market cap. Today, they're 20%. Return on equity was 16. Today, it's 22. Margins were 9%, profit margins, net profit margins. Today, they're 14. It is not your grandfather's index.
That's a good point.
Yeah.
That's a good point.
Yeah.
30 seconds left here. Is there a sector out there that screens well for you at this point?
Yeah, just to kind of shift gears from all this tech stuff. First of all, I appreciate your comment about Walmart earlier on the show.
Well, thank you for listening, Jeff.
Hey, man, you know what? You learn. But healthcare would be a selective consumer and healthcare, and I think energy could be a surprise.
Energy, that is a surprise because we got oil at $58 a barrel here.
Yeah, but if you look at the charts, we're starting to see some interest as people diversify from just the tech trade.
Yep.
I'm just going to interject a minute with Walmart because they're going to move their stock listing from the New York Stock Exchange to the NASDAQ. Am I missing something? Is that a big deal? Because talk about this is not your grandfather's market anymore. I don't know if I could remember a time when I think, oh, yeah, sure, that move makes sense. Does that make sense to you?
Well, it does because e-commerce was up 27%. It's so much more of a technology company. So, think about it. When you search for something, automatically you go online to Walmart, so. Yeah.
However, the NYSE, I would not have allowed that to happen. I would have done anything to keep that name there. Jeff Krumpelman, CIO and head of equities at Mariner Wealth Advisors based there in Cincinnati, Ohio. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Talking about the Fed, can't stop talking about the Fed as we lead up to their two-day meeting, December 9th and 10th. And in an environment where we're thinking perhaps we could be in for some interest rate cuts, lower rates for longer, what does that all mean to commercial real estate? Let's bring in an expert to sift through it all. Rich Hill in our Interactive Broker studio with us, Global Head of Real Estate Strategy and Research, Principal Asset Management. Rich, good to see you here in the studio.
Good morning. Thanks for having me in.
So just paint the picture for us as we head into this Fed meeting where there's a big question mark as to whether or not we get that third interest rate cut of the year. What is the commercial real estate landscape looking like heading into that meeting?
Yeah, sure. Well, first of all, I think it's important to level set. Commercial real estate is one of the few asset classes in the world where valuations have significantly reset. Private real estate valuations are down 20 to 25% in the US and in Europe. Public valuations are down around the same amount. We think this is a cycle going through a normal reset. That's hard to understand because there's a lot going on and a lot of noise, but let me explain what I think that means. Listed REITs trough first because they're leading indicators in both downturns and recoveries. Listed REITs troughed in October of 2023, and they're up more than 35% from those levels. Private valuations troughed 12 to 18 months later. We've now seen 5 consecutive quarters in the United States where total returns are higher. It's 6 quarters in Europe. There's actually something that happens, though, in a lagging indicator that I think confuses a lot of people. Distress in the commercial real estate markets doesn't peak out until after private valuations trough. Why is that happening? Well, it's part of the grieving process. Banks don't like to sell distressed loans into distressed markets. They like to sell distressed loans into stabilized markets. So that's where we think we are. You bring up a good question, though. What about interest rate cuts? You hear a lot of commercial real estate professionals saying, we want lower interest rates. That's not our view. We want stable interest rates. And the reason I say we don't want lower interest rates, and I'm really talking about long-term interest rates because commercial real estate borrowers finance themselves with long-term interest rates. If you have meaningfully lower interest rates, be careful what you wish for. That actually might mean a weaker economy. That might mean tighter financial conditions, wider credit spreads. That's not good for any risk asset, including commercial real estate. What we're really rooting for here is stability. That's what we think the market needs to see. That's what we think commercial real estate investors want to see.
I can explain something to you, what I've learned about commercial real estate business.
Yeah.
It's controlled by these Morgan Stanley guys. They're everywhere. The Morgan Stanley commercial real estate business is by far the biggest and best on the street, but it's a cabal. They leave Morgan Stanley and they put their tentacles all around the commercial. It's a total scam. They're everywhere. And nobody's better at it than these Morgan Stanley folks. Rich, in the U.S. here, have we troughed in, let's say, office? Have we troughed in office here? Because I'm hearing some positive murmurs, even about like New York and San Francisco.
Yeah, sure. So it's really hard to, and I'm going to be super cliche here, paint office with a really broad brush.
Yeah.
And the reason I say that is JLL has a great statistic that 90% of vacancy in the United States is concentrated in 30 to 35% of buildings. New York City, really strong. It's seen a really strong rebound. San Francisco, beginning to see some real signs of life.
AI.
And if you're a long-term investor, you're pretty bullish on San Francisco because of how beaten down it is. I think the market is still trying to figure out what the high-quality buildings are from the lower-quality buildings. We actually don't have an office problem in the United States. We have a Class B and C office problem.
Because those older buildings, you mean?
100%. And if you were renting a Class B and C office property prior to COVID, you probably didn't value the office experience. Here's my ultimate point with office. I don't know when it bottoms. I'm not really good at picking bottoms. Other people do a better job of that than me. But I do think over the medium to long term, we're going to look back and we're going to say the office sector is one of the sectors that performed really well over the next 10 years. Usually last cycle's losers aren't next cycle's losers.
Yeah, okay. So if Class B and C is sort of not the place to be in terms of office, is it the place to be when you're thinking about converting office to residential, which we've seen a lot of in some of our major cities?
Yeah. Highly attractive investment thesis. Really hard to do in practice. There's probably 150 to 200 buildings across the United States where you can actually do it. Why is it working so well in New York City? Well, it comes back down to how you think about affordability in the United States. We're really big believers that you don't need to regulate what you have. You need to build more of what you don't have. We don't have enough housing in New York City, and frankly, we don't have enough housing across the United States for various different reasons. So I'm a really big proponent of converting office into multifamily. It's just not for the faint of heart, and it's a lot harder to do in practice.
And probably pretty expensive to retrofit, is it not?
Yeah, it is. In many cases, it's actually easier to raise a building, so that's to bulldoze it and build from the ground up, because it's not that much different. But if you have the right floor plate in office and convert it to multifamily, really lucrative investment thesis.
That's true. I never thought about it, because when we raised and built a home, I was shocked at how cheap it was to tear down a home. The guy could have quoted me 10x what he quoted me, and I would have paid it, because I had no idea.
Because it's really about the land it's sitting on, right? Yeah. Location.
This dude brought in like a backhoe and just knocked it down in like 15 minutes.
Crazy.
I mean, it was unbelievable. I didn't understand about that. All right, so where, Rich, is the best value out there in the broader commercial real estate these days? Where are you guys seeing it?
Yeah, there's three things that I want to talk about today. The first point, we can't be talking about commercial real estate and you can't be talking about markets if you're not talking about AI and data centers.
Okay.
So we think data centers are really interesting, but with a nuance. First of all, I think it's important to unpack AI demand from data center demand. Data center demand is constrained by land and power right now. You actually have way more demand than you have the ability to create data centers right now. That's the first point. The second point is when you're investing in a data center, you're actually investing in infrastructure. The land, the ability to power the land, the fiber that goes to the land. The third point, which I think is a nuance that the market's just now beginning to understand, is not all data centers are created the same. When we think about data centers, we think about cloud data centers. That's when, like you and I are on Bloomberg right now, it uses cloud. There's AI inference, which is when you and I go on ChatGPT and prompt ChatGPT. And then there's generative AI. Generative AI is training models for future AI demand. We're really quite bullish on cloud and AI inference. We're much more cautious on generative AI. But we think focusing on cloud and AI inference, which is actual existing demand, that's a really interesting asset class. We're a developer in the United States, and we think we can develop these at unlevered IRRs and call it the 20% range, which ends up being really attractive. So I'll pause there. You might have questions about data centers, and then we can move on.
I don't think we've hit a topic where we haven't talked about AI. It is infiltrating just about everywhere. Real quick, Rich, where within commercial real estate can they benefit most from AI?
Yeah, data centers number one, but it's actually helping the entire world in a lot of different ways. I'll come back to what you were talking about office. There's a lot of questions about how AI is going to impact office. The reality is, I think we're still early innings about how it's going to impact office. what workers are going to be upskilled, what workers are going to be downskilled, what workers are going to be outskilled. But there are going to be markets that benefit significantly from AI. It is changing the world, and commercial real estate is a big beneficiary of that. So we think there's going to be a lot of efficiencies that are driven by AI.
Rich, thanks so much. Appreciate that. Rich Hill, Global Head of Real Estate Strategy and Research at Principal Asset Management.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.